What if I told you that the real economic apocalypse right now is that consumers are running out of money? And despite stocks sitting near all-time highs, everyday Americans are ditching fast casual meals because they can't afford them anymore. And you know when a consumer can't afford a burrito, that something is very wrong with the economy. And this isn't just a restaurant slump. It's a canary in the coal mine signaling a massive consumer pullback that I've been warning about, that could tank jobs, spike bills, and wipe out trillions in stock value. Now stick around because ignoring this could cost you everything you saved. But not to worry, I'm going to give you the exact blueprint of what you need to do right now, not just to survive the coming crisis, but thrive. And tonight's show is brought to you by Novu Bond Graphite. You can find them on the NYSE and the symbol NMG. Now get ready because they're a company that's charging ahead with a massive graphite demand that's exploding for electric vehicles. And analysts right now are targeting a 30% move higher. Put this one on your hot list because you don't want to miss out on the rally. Stay tuned to the end of the show or check out the pinned comment or description for more information. Because this morning, Chipotle stock crashed 18% in pre-market trading. It's now down 34% from the year and completely underperforming the broad market. And based on what we're seeing from consumers, this is just the beginning. Chipotle Mexican Grill fell after cutting its full-year outlook for the third time this year as diners pull back from eating out at the fast casual chain. The consumer slowdown is really affecting our business in a meaningful way. This from CEO Scott Boatwright. And absolutely, because what we're seeing is this slowdown is occurring because wage growth is slowing. Hours worked are falling, and we still are dealing with rising inflation, despite the fact that the Fed said it's not that big of a deal anymore and that it's coming down. The bottom line, consumers have less discretionary money, and we're now seeing it in the real economy. About 40% of the company's customers come from households that make less than $100,000 a year, and that income cohort has significantly cut back on eating out due to concerns about the economy and inflation. Except it's not about the economy or inflation. It's about incomes. And let's take a look at some proof. How about this chart of advanced retail sales in blue against total income of production and non-supervisory employees shown in red. And you can see very clearly the strong relationship as incomes decelerate, takes retail sales, and that means burrito sales right along with it. We see that happen going into the financial crisis right around 2012 when the economy was facing a double-dip recession. And now we're seeing it again. And we know this is happening because the evidence is based on the consumer sentiment data that hours worked are going to fall even more in the months to come. Now, Boatwright said that customers in their late 20s and early 30s are particularly challenged due to unemployment, student loan debt, and slower wage growth. This is exactly the problem. The economy isn't working for younger people. Now they're having to restart their student loan repayments or they're going to go into default. Now I said before this would lead to forced repayment by the end of the year and ultimately tank consumption. Now you're seeing it happen in real time. It's not just slower wage growth. This happens as unemployment rises and you have too much available workers, but fewer hours and fewer opportunities for holiday work. It's all adding up to the perfect storm. But the problem is, it's not just the youth that are affected. Sales growth will likely remain pressured into next year with lower and lower middle income customers balking at meal prices. This is according to Guggenheim analyst Gregory Frankfort. And what we're seeing is financial stress from low-income workers is flowing right up to the middle class, just as I predicted. And this is why delinquencies are rising. This is why subprime lender Tricolor failed. Consumers are simply running out of money. They can't afford to pay all their debts, and they can't continue to maintain their discretionary spending. Something has to break, and now we're seeing it's right in discretionary spending. Chipotle is offering more limited time menu items while boosting advertising, but quarterly results show these efforts are falling short. Because as I said when McDonald's did this, it's not about gimmicks. It's about consumers can't afford higher prices. Now this isn't just a Chipotle problem. It's a red flag for the economy. Let's dive in deeper because on the back of Chipotle's warning, let's escalate the Fed's role in all of this mess. Now, yesterday we heard from Fed Chair Jerome Powell that one of the reasons for cutting rate was, quote, job gains have slowed this year and the unemployment rate has edged up or remained low through August. More recent indicators are consistent with these developments. What's the translation? The Fed's finally acknowledging that subprime bankruptcies aren't isolated flukes, as Wall Street said they were. They're symptoms of a labor market chill that's fueling holiday spending slumps, surging delinquencies, and yes, the big drop in Chipotle's traffic. Let's take a quick look at the chart for our sponsor for today's show, Novu Bond Graphite. Again, you can find them on the New York Stock Exchange under the symbol NMG. And here you can see recently the stock surged higher, is now pulling back into support right above its 50-day moving average. Analysts, well, they think it hits $3.80. That would represent a 30% move higher from where it's at. Definitely want to put NMG on your hot list. Stay tuned to the end of the show for more information. Now, Powell made it clear that the primary concern for some is a cooling job market. Others inside the Fed are warning persistent inflation will limit room for more easing. But their biggest fear is crystallizing. We have a cooling labor market, and some insiders are pushing for aggressive easing, while others are saying, look, I'm worried about inflation, and this is going to keep us from making a move. But here's the hard truth. The Fed might disregard sticky inflation to prop up jobs, yet rate cuts alone won't spark hiring or boost wallets. What does? Rising wages and more hours on the clock, something workers aren't seeing more of. So what we're facing are fewer jobs, fewer hours, spending's going to crater, and that's going to drag inflation right down with it in a vicious cycle. And here is the proof. Let's take a look at this chart of the Consumer Price Index shown in blue against average weekly hours of production and non-supervisory employees in red. So I want you to see very clearly that going into recessions, what happens is weekly hours are on the decline. You can see inflation rising and squeezing wallets, and then next thing you know, with a lag, inflation tends to come crashing down. We see that happen going the dot-com bubble. You see it again in the financial crisis, and we're facing it now. Even though the Fed said inflation is heading in the right direction, it's not for most Americans. So what we're facing right now is the Fed's in a conundrum, and Wall Street wants them to cut. And Powell said a further reduction in the policy rate at the December meeting is not a foregone conclusion. In fact, far from it. Because any more cuts at this point, the Fed's admitting we're in a recession. And if they do that, they risk the stock market selling off. And that means those that do have money and their net worth tied to stock prices, they're going to cut back. And for the economy, that's the worst thing that could happen right now. But for the average American worker, the pain is just beginning. Because global firms are slashing jobs amid weak sentiment and an AI push. Now for the middle class, this is the nightmare scenario. Companies are looking to spend on AI and even more money on AI to replace them. Now 78% of executives said they're under intense pressure from boards and investors to prove AI is saving money and boosting profits. The problem is it's not doing that at all. But companies are spending more and more money on AI. They've cut spending where they can. And just as I warned, this would lead to job losses, and now we're starting to see it. So despite the headlines, economists say the labor market is stuck in a low hiring, low firing phase, with firms quietly trimming headcount by not replacing vacated roles. And here's the bottom line. If holiday sales disappoint, and it's likely they're going to because Chipotle just gave us an early indicator that consumers are running out of money, what this means into next year, we're going to see more job cuts. We've heard this from retailers. We're going to see it from manufacturers, wholesalers, people in the transportation sector, you name it. Everybody is going to cut back. But don't panic, because I'm going to give you the actionable steps you need to take right now to safeguard your finances. So as you can see, the storm I've been warning about is starting to hit. Chipotle's slump is exposing income cracks that I've been warning about. And Fed paralysis is going to put them behind the curve, but they always are. And AI job threats are real and likely to accelerate holiday spending. I predict it's going to be a dud. But this doesn't have to be doom. This is your wake-up call. Now here's what you need to do right now to protect your finances. I want you to lock in your high-yield savings rate. Now the Fed's saying don't count on a cut in December, but better believe there'll probably be one in January and February. Take profits on your big gainers and rotate into defensive. How about dumping those consumer discretionary stocks? Based on what Chipotle said, it's starting to look like a good idea. Hedge your long gold positions or look to sell if you're a trader. Remember, the Fed's second rate cut is historically bearish for gold. Add dollars to your portfolio, and remember, if you look at a chart, the dollar's just starting to rally. And treasuries follows the Fed. So keep in mind, if you take these steps right now, you won't just survive the upcoming crisis, you're going to thrive. And speaking of recession-proof plays, let's take a look at our sponsor for today's show, Novu Bond Graphite. You can find them on the NYSE and symbol NMG. Everything you need to know, again, in the pinned comment and description below. Now let's dive into Novu Bond Graphite. Now this Canadian powerhouse is all about turning natural graphite into top-notch battery materials for clean energy boom. They're building a fully integrated operation from mine to market, and with EV sales skyrocketing, their future is looking electric. Now check this out, just a couple months ago, NMG dropped some big news on their phase 2 projects. They're pushing hard toward a final go-ahead for their Madawane mine and Balcor plant, locking in tech tweaks, funding chats, and chats with some big buyers. This means they're gearing up to pump out high-purity graphite. It's perfect for batteries. Now let's take a look at their latest pitch deck because they've nailed it. NMG is on track to be one of the biggest players in the West for natural graphite. No more relying on overseas stuff. They're going local in Quebec with clean hydropower, slashing costs, and going carbon neutral. And that's a game changer as graphite demand is set to jump by over 500% by 2030. And the buzz is real. Analysts just pumped their price target up by 20% this week. Plus, the stock popped 11% earlier this month. Now, with graphite needs blasting 310% by 2036 for EVs and energy storage, NMG's got the scale and smarts to grab a huge slice. And check out these killer partnerships like offtakes with Panasonic Energy and GM, who even invested $100 million last year. These deals reserve most of their output, and with phase 3 expansion eyeing 500,000 tons a year, growth is in overdrive. Let's take a quick look at the chart for our sponsor for today's show, Novubon Graphite. Again, you can find them on the New York Stock Exchange under the symbol NMG. And here you can see recently the stock surged higher, is now pulling back into support right above its 50-day moving average. Analysts, well, they think it hits $3.80. That would represent a 30% move higher from where it's at. Definitely want to put NMG on your hot list. Now, they're located in a premier operating jurisdiction with trade agreements with 51 countries and strategically located to supply North American and European markets. I want you to keep an eye on Novubon Graphite. Put them on your hot list. They're under the symbol NMG on the NYSE. Remember, with Novubon Graphite, the sky is the limit. And as always, with any company we feature on our show, you're under no obligation to purchase their stock. Be sure to do your own research before placing any trades. And use your risk control levels when you do. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.